So we better get our Fed window ready. Where is my Fed window? Well, there's not much to it, right? It's just a one-page report that they do. FOMC meeting calendar. Yep. So exciting. May, we already did May. So we're up to June, and today is June 14th already. Oof. All right, video seems to be working. Everyone seems to be happy. Things are happening now. All right, so what's going on? Well, the most important thing, let's talk about what's, we did our portfolio review. So not the top trade review, we want the portfolio review. Phil's posts. There's our posts. There's all the people following our posts. Let's see, which way? Wednesday, Fed pause, NASDAQ. No, what was I saying? Portfolio review, right. That was yesterday. So basically, let's just not get into the weeds of this. I mean, you guys can read it. It was just put up yesterday. So basically, we have the, this is a Money Talk portfolio that we haven't touched. Oh, Barbara was in Japan. That's why the producer of Money Talk has been in Japan for a few weeks, and that's why I haven't been on. And they don't have a thing yet, but they're going to put me on pretty soon. I was wondering why she didn't call me. She called me last night and said I was in Japan. So let's see. Super thirsty, sorry. So the Money Talk portfolio, we haven't touched it since God knows when. I mean, May, I think, was the last time I was on, maybe. Was I on in May? No, that didn't sound right. Like March. Well, we can tell by when the last entry was. Here's March. Yeah, it was March. In March, we added IBM and we added Qualcomm because we want to stay away from the, because we like tech, we want to stay away from the financials, and I like the big safe guys. So we picked up those two. And they're both plodding along and doing okay. Overall, we're up 282% at $382,000. We started with, I don't know. Did we start with 100 in this one? I think we started 100 in this one. Obviously, we did if we're up 282%. So we started with 100,000, but this one's old. This is probably year 4 of this portfolio. But still, it's a nice gain overall. And we've got Simon Properties, a mall operator, which you would think would not be doing good, but they're a good company. Barrick Gold, IBM, Intel, JP Morgan, Logitech just had bad news. Today they're down, but they're down 255. They were 63 2 days ago. They're down to 55 but 55 is our target, so we don't really care, and it's our target for the end of the year. We weren't going to get paid more than that anyway, so it doesn't matter. The CEO left for whatever reason, and I mean, I guess he left a little suddenly, but people, sometimes people get sick, sometimes it's family, sometimes whatever, whatever the reason was, it doesn't seem to be really impacting the business. Oops. Let's see what happens here. I want to look at charts, and I want to look at LOGI. All right, so 56 now. So I mean, it's like crazy. It's down 12% in a day, and But well, let's get into it. In fact, I'll talk about it. But I mean, in the context. So, SoFi, Yeti, whatever. Let's finish your portfolio review and talk more about that. I'm not going to review every position. It's not worth it. I think I was pretty clear in my writing about how we did. Here's the $700 a month portfolio. That one is up 47%. That's crazy. Are we still up that much today? That is a crazy amount to be up. But we, the thing is, we started the portfolio right at the beginning of this nice rally we've had in May. But that's 1 month, 47%. That's a little nutty. And when you 49%, even better. The thing is that when you make money very easily, then you've got to be concerned that you can also lose it very easily. So, this one is not new. We started on 825 because we're only putting in 700 a month, but we've had a really nice run. I mean, we caught the entire rally of the market this year, and it's just phenomenal. I mean, especially for our portfolio where we aren't even using margin for anything. So that's really nice. What do we say? The money talk was like 285, and today it's 286. So everything's still going up. Anyway, back to the actual review of it, which was here. Yeah. So everything's still continuing along. This is, what is this? This is, oh, I'm sorry, that was my example. That's saying 1 month ago, the $700 a month portfolio was at -4%. And so we added some money, and we added some money. If you go back to this review, which is a link over there, you can see we added a couple of positions, we spread a little bit of money around, and we just benefited from the pop. I mean, they were the right positions, and it was the wrong time. And that's what you have to learn about options trading. You have to understand that you need to be patient and let things play out. You can't freak out just because something goes wrong. And we were, because we were up almost 20%, then we were down to 0%. But it was just, when we looked at it, we said, well, these are just fluctuations in the portfolio. None of these positions were anything we were worried about. I think we got more aggressive on SunPower, right? Because SunPower is now, I don't know, it's still 5 and 5. What did we do? UNG, Sophie, we were aggressive on. NYCB was 6 and 6. It's still 6 and 6. Nope, we didn't touch any of those positions. We just added stuff. So since that review, we did what? We did a lot of stuff in, oh, here you go. No, that was UNG was already there. Wow. Okay, so we added Future Fuel. Didn't make any money anyway. We add that was 423. We added SQ. Oh, we just put on the SQQ hedge. We added BBAR. We added IVZ. These are only recently from last week. So mostly it was the same exact positions, just making some money. It's not even because of the new position. They're only up like a little bit. They're okay, but they're up a little bit. The old positions are what made all the money. SoFi was negative 431 or whatever, 400 and something. Now it's positive $2,000. That's in this size portfolio. It's a huge swing. So it's, you have to learn to look at your positions. There's nothing wrong with this position. Okay, it's the market that is wrong, not the position that is wrong. NYCB, I think, also made some money. Yeah, NYCB added some money. SunPower did not particularly add any money, but it evened out a little bit. UNG, well, yeah, just basically everything made some money, but mostly SoFi. That made a lot of money. And that's what changed it around. But that's the whole trick. You gotta, it's the planting trees thing. You guys know that, right? We've talked about that before. It's that whole concept of planting trees. You don't plant one tree and put all your money in the one tree, right? You plant a bunch of trees, and some of them will grow and some of them will fail. And the ones that grow, you nurture them and help them grow along the way. And the ones that fail, you pull out the roots, you get rid of it, and you allow that to be a clear space in the forest, or you plant another one. but you keep planting trees and you let the things grow in their time. You don't go around and kick it every day that it hasn't popped out of the ground yet, and you don't get mad at it every time there's like a storm and a branch breaks or something like that. It's a tree, leave it alone, let it grow. If you pick value picks in your portfolio, it's the same concept. Put value stocks in your portfolio and leave them alone. And I'm not saying ignore it if the news is bad, if things turn off, if the market changes substantially. But if nothing changes in your premise and your premise remains fairly valid when you look at it the next time and the next time and the next time, then don't change the position. It's not your fault that other people are stupid. That's probably should be our new motto, right? It's not your fault that other people are stupid. But stocks can be misvalued for very, very long periods of time. In fact, well, we'll get back to that too. I've just picked out a whole bunch in the on our watch list that are like that. So the butterfly portfolio, and again, these are 1 month portfolios. This is up 4%. Only got 3 stocks: Apple, International Paper, and Pfizer. This is the income portfolio, which is up a nice 18% already. Very nice. And it's a month. It's only a month. Doing good. Doing what it's supposed to do, making money. And this is the long-term portfolio. The long-term portfolio not doing anything, 1.1%. Oh, and part of that reason is also that whenever you add options into your portfolio, you're not gonna, you could actually be immediately losing money, because your portfolio is going to show you, when you're long, it shows you the bid, and when you're short, it shows you the ask. So you're always going to get like almost a worst case scenario for the position, and you should be able to do much better when you actually go to sell things. That should actually improve your portfolio when you actually cash things out, as long as you don't do limit orders, which is very bad. So the long-term portfolio is up 1%, and that brings us to our short-term portfolio, I think, eventually. And our short-term portfolio is down 8%. Why? Because it's got the hedges in it, and we're over-hedged. We were hoping that there would be a big downturn and we'd make a quick bunch of money, but we didn't get the big downturn, and so we are down in that portfolio. So what do we have to do? We have to add longs to offset it. So I did 2 things today. That's what I wanted to really talk about. Is maybe one was yesterday. STP. Nope. STP. There you go. So I want to start offsetting that loss, and that's all I have to do. I look at the loss right in the short-term portfolio, wherever it went. Oh, we got off the page. That's why. Oh, here it is. So we have a loss of $200,000 portfolio. So we have a loss of $17,000. And I say, well, how am I going to make up $17,000? Well, Logitech, as I said, the CEO just quit. We know we like Logitech. It's in one of our other portfolios. So what do? I go back to Logitech. So even though we have it, I'm still going to double check it. So we go back to Logitech. And we've already done all the background checks and all the work on these guys, so I know what I'm going to find when I look over here. $10 billion company. They are, wait a minute, what's the price? 57.02. So it's $10 billion company. They can't have much debt up. They have $1 billion in cash, 1 point whatever billion in cash on the books. That's nice. That makes them really a $9 billion company, right? Wait, yeah, 9 billion. So they're really like a $9 billion company. They make almost $500 million a year. They have made more in the past. Earnings are down, and they're coming back up. They've had to change their product mix and so on and so forth. But we knew about that. We knew they were investing and turning around. It's going to be trickier and trickier, though, for them down the road, because if you think about it, the more you have AI, And the more stuff gets done on your computer and so on and so forth with just talking to a computer and having it in your pocket and getting instant answers, the less you need these mice and keyboards and so on and so forth. So, you know, these accessories Logitech makes are probably going to be a diminishing market. But we'll see what happens. But still, let's say they get back to somewhere around 600 million in profit, it's perfectly fine. And we're not playing them to leap up, but we are playing them to be where they are now. And of course, we like the cash balance, which has been steadily increasing. All right, so it's overall, it's a pretty good little company. Just because the CEO left, and look, the CEO might have left because if you're a static company, there's not a lot of opportunity for the CEO, right? Let's say maybe the CEO got an offer to join a different firm that's got huge growth prospects. Logitech does not. Not going to fool ourselves. They don't have great growth prospects. Oh, they're behind the inflation curve. That's what's wrong with them. They've gotten increases in prices that they have not yet passed along, but eventually they'll increase their prices and that'll roll in and the profits will come back. That was my premise on them. I remember that now. So, you know, the CEO could have left because he had a family thing. He could have left because he had a health thing. He could have left because he got a better offer somewhere. You don't know yet. It'll be announced. We'll find out. But meanwhile, you know, and again, if you're a good CEO and you're going to get offers from other companies, the companies are going to say, hey, you're in a $20 billion company. You're not going to grow it much more than 5 or 10% in the next couple of years. There's nothing thrilling that's going to happen to you investment-wise or anything else, and they're not going to bump up your salary some huge amount. It's a niche company. It's going to be pretty flat. I like niche companies. I like companies that consistently return my money on a regular basis. But, and so, you know, 20 times the earnings is 5 means they're making 5% on my money. 5% just isn't that sexy right now. They got to get it up to like 8% to keep up with inflation and alternatives that we could invest in. So meanwhile, Mr. Chairman of Logitech, he may get an offer from, you know, some other companies as an AI chip company or something like that, that's probably going to grow 50% in the next couple of years. And his options alone on his position are going to make him $100 million, you know, if he grows the company properly. These guys are never going to give him that kind of money. So boom, goodbye CEO. Does it reflect poorly on Logitech? No, it's not that kind of company. They'll find another CEO. They'll find somebody who's happy to sit in a chair for a few $1 million and run the company. But, you know, the guy who was running it, maybe he outgrew it. That's all there is to it. No big deal. So anyway, no terrible thing about Logitech. What's our play? Our play is to sell the $55 puts, which is where it came down to. So they bottomed out. They see the bottom here. They bottomed out about 55 bucks. So I sold the highest puts I wanted to at 55. They're $7. So our net is 48. Now, $48, if I can find that chart. So $48 is lower than it crashed in March. So to me, that's like a dead buying. Look at that huge stick of buying over there. Somebody saw what I saw and was like, oh, come on. All right. So what I'm doing here is we take, as it crashes to 55, we take advantage of the dip, sell the 55. Oh, way down here. We sold the $55 puts for $7 more. So our net is 48. So that's all we're doing. I'm just saying I don't think Logitech goes below 48. And that's what we're putting in the portfolio. And I said it's going to use $7,500 in margin. And we're going to collect $14,000, and that offsets half the loss, I think, in the short-term portfolio. Is that right? No, more than half. It was only 17,000. Wait, 190? Yeah, only $17,000 loss. So it offsets almost all of the loss so far. And that's all I want to do with the short-term portfolio. It's insurance. So all I have to do is have it pay for itself, and I'm happy. So theoretically, I think Logitech, if the market is good and the short-term portfolio performs poorly, then Logitech should perform okay and stay above 55, and therefore the 14,000 expires worthless, and we keep all that money and it pays for our loss. That's all this stuff is. It's a balancing act. How can I balance this out? If the money we have in the short-term portfolio over the course of 2 years stays neutral and the market goes up, we're happy. It's better than you do for insurance, right? But you don't get pissed off when your insurance goes down. Like I buy, you have a life insurance payment of, maybe $1,000 a month for life insurance payment if you have $1 million policy, and that's $12,000 a year. But you don't sit there at the end of the year and go, oh, God damn it, I didn't die again. Like, you have insurance in case you die, but it doesn't mean you want to die. You would rather lose the $12,000 by paying the insurance, right? That is preferable to dying. So this is the same thing. When you have a hedging portfolio, it's your insurance policy against a catastrophe that you kind of hope doesn't happen. But on the other hand, if you're not making money in your long-term portfolios, if the market going up or staying flat is not beneficial to you, then what's the point of the insurance? So we're building right now, and it's only been a month, but that's what it is. There's quite a bit of a balancing act where you adjust one side, then adjust the other side, then adjust the other side, then adjust the other side. Once the long-term portfolio is full of positions, then we'll know how much insurance we really require. But right now we are way overinsured. Okay, this is much more insurance than we need. We thought the market was going to crash and it hasn't, so we need more longs at the moment. All right, so we did that with the STP, and then we added in the long-term portfolio. We just this minute, right before the webinar, added JP Morgan. It's funny because we were talking about JP Morgan. Peter said, I have JP Morgan and Cisco, and I said, well, I think if you've had JP Morgan and you're in it, it's about done as far as moving up. And he has shares, not options, so it's a different concept. But he has shares, and I'm like, why would you type that money in JP Morgan? It's not really going to go anywhere. Here's the logic for why it's not going to go anywhere. It's basically the basic logic on JP Morgan. I can illustrate that here. Look at that, 9 times earnings, 10 times earnings. So the basic logic on JP Morgan is, look at them. They had 115, 119, 121. So here's good steady growth, right? But apparently they had some lucky occurrence here or whatever. It had to do with the stimulus, it had to do with whatever they were doing at the time. But they had a lucky occurrence there that led them, and the market crashed, and of course they bought it. That was another thing. So they had a nice opportunity here where they made a ton of money. But it wasn't like and the people who were in that year expected it would keep going up, and they paid the price accordingly for the stock. That did not happen. They went back, and even though they went back to a much higher number than 29, it seemed disappointing. So then they go back to 37, and now they trade. They're on pace for actually not on pace for 43. They're a little below 43. They're probably going to pace around 40 at the way they're going. And then they don't expect more than 40 next year, based on what they're seeing in the market and so on and so forth. So basically, this is where they should be. They were going along here, and they had a disappointing year. Then they had a really good year. Then they disappointed, and now they're getting a little bit back towards where they should be. But the path, if you look at the real path, it went from here to here, and it should have gone through to here, and it should end up about here, 150. Then and that's what you are seeing here. If you average out the numbers, you're seeing slow, steady, nice growth. Everything's great except for people freak out when it's too low and go crazy when it's too high, and they don't understand that you can just play the middle and make plenty of money. All right, net debt. That's a crazy number. I don't know where that came from. So net debt, whatever. You can't. They got $3 trillion. I mean, they'll figure it out. Don't worry about that, JP Morgan. That's the thing about all these banks, and they're cyclical. That's why they trade at 9. Maybe they'll lose money one year. You never know. But you're in it for the fact that they have certainly the capability of making $50 billion a year, and they're not even a $500 billion company. So it's a great stock, but it's not a great stock as a stock because it could go up or down or whatever. But what is our play? So I'm saying, okay, same thing as I just said about Logitech. Let's sell the 125 puts for 12 bucks. That's net 113. All right, back to oops. Nope, that's not JP Morgan. Oh, well, that's not even a good chart for it. So back to JP Morgan 5 years. So 113, that's down here. That's not likely. This was a financial crisis. It didn't even, oh, I'm sorry, this was the COVID crisis. In the financial crisis, we hit 113, just like, this. Oh, that's not even, no, I'm sorry, that's November. I take that back. In the financial crisis where everybody just freaked out in March, right? We were still over 120. Last year's low was 113. Way back in the beginning of COVID, when we thought the world was going to end, we're still at 100. So I'm pretty comfortable netting in for 113. So step one, I get $12,000 for free. Step two, we pick up 15 of the 130, 150 spread. So they're at 140. They're right in between that. So this spread that we're picking up is $15,000 in the money right now. Right now, it's $15,000 in the money. These shorts are well out of the money. They're 10% out of the money. We're at 140. These are 125s. So these are more than 10% below the current price. This spread is more than $10 in the money, which would be $15,000 if it closed today at this price. And we're paying net $3,000 for the spread. It's a $30,000 spread. It's going to pay us back $27,000 if JP Morgan goes up $10 between now and December of 2025. So that's all of 2025, all of 2024 too, and half of 2023. So 2.5 year spread. So in the next 2.5 years, 48 plus 6 is 54 months or whatever the heck. No. Sorry, 48, 24. 24 plus 6. So in the next 30 months, we want JP Morgan to go up $10, not even 10%, and we will make 900%. So if we're right, and this is the key, because when you're a value investor, the only thing that matters is that you know how to pick a value. That's what matters. Everything else takes care of itself. If I'm right and JP Morgan is going to stay above 140 where it is right now, if this is a value position right now, we are going to make 15,000 where we'll close at 15,000 plus that'll be a $12,000 gain, which is only 400%. So if it's flat, we make 400%. If it drops 10%, we're still going to be, we'll still be about even if it drops 10%. If it goes up 10%, we're going to make not even 10%. We're going to make 900%. We're going to make $27,000 on this position. That's a good trade. That's the kind of trade you want in your portfolio. It's like, how am I going to lose? And of course the market could crash and so on and so forth. That's what the hedges are for. Right? That's why we have the hedges, those crazy hedges that we worry about losing money on. But all we have to do is fill up this portfolio with trades that'll make $27,000 if we don't need the hedges. And that loss on the hedging portfolio is going to mean nothing to us. And keep in mind that is exactly what we've been doing for years in the old portfolios that we just closed. It's just that if you've been here, if you only joined us in the last few years, you've already seen we've already had these portfolios for a couple of years. They were already up hundreds of %, and it just seemed like nothing. We would just throw money at something, throw money at something, throw money at something. It was all house money. But now we're playing with our own money. So we're being actually more cautious than we are when we get these, once we develop the portfolios. Once we double up, I'm a lot more happy to take risks. But until we double up, these are my kind of plays, these nice conservative plays where it's like, how the hell do you make take $3,000 and make $27,000 when it's hard to imagine there can be enough downside for you to lose? JP Morgan has to fall to a low it hasn't seen in ages for you to lose money on this trade. Has to be terrible market conditions. I think those market conditions are terrible enough that the short-term portfolio will more than cover the loss. So that's easy enough, right? And then now we can take it and start looking at, we got 20 minutes. So in 20 minutes or less, let's look at, it was that same conversation. Oh yeah. So, he talked about having JPM and Cisco, and I said, well, look, these are financials that are probably better than JPM. BlackRock, BXMT, which is still BlackRock, or is that Blackstone? I forget, it's one of those black guys. BXMT, Blackstone, right? So Blackstone Mortgage Trust is a REIT that everybody, for some reason, ran away from. I think they're great. The PE is 7, it's $3.4 billion. Okay, they make, here they are, look, 780. So whatever in 2022, ignore that and just figure that they're kind of on this pace. So they're about good for 700 million. They make about 200 to 300 million normally, but they seem to be getting better at making money and on less revenues. It is what it is. The debt, again, these REITs, you can't really pay attention to the REITs debt because that's how they work. That's what they do, is that they make their money selling the debt. So, or they borrow money and then relend it and make the money on the spread. So of course they're going to have debt. But it's just a perfectly fine functional REIT, and for some reason nobody wants it. It got mispriced like crazy. Now we put it on the list. Well, I think we had it on the list back in November. I don't know, unless I added it later. I honestly couldn't tell you. I'm pretty sure we added it when it was really stupidly low though. And it's back to 20, but 20 is still fine. I'm more worried about it getting away from us now. So that was that one. Where were we? Citibank, very cheap. Capital Financial, cheap. CIM is, of course, we have some short puts on these guys. Jackson Hewitt is funny. Whenever they're low, we like to buy them. They're often low. All right, so I mean, this is going back to 2021. I mean, look at them. They go up, they go down, they go up, they go down. Right now they're down. I want to buy them. So here's Jackson Financial, $2.5 billion. This is what's funny about these guys. $2.5 billion market cap, right? They made $5 billion year. See, $5.6 billion last year. They divested business, so they're not going to get back to that number. They sold it. That's why they made so much money. They sold a big piece of business at a profit, but they left themselves with a nice profitable piece of business. $6 billion, it makes 1.2. Remember, you buy the whole company for 2.5 billion. They will make all the money you give them in this year and next. But wait, there's more. Oh no, they spent. Oh no. I apologize. It looks like I don't know what the number is here. It looks, that's a TTM is a different measurement. Oof. anyway, last year when we were looking at them, they had this for sure. They had $1.6 billion in net cash on the books, net of debt. Now, I don't know what their situation is right now. Well, let's ask what? Let's ask. Okay. Can you please tell me, as of June 14, 2023, how much cash net of debt JXN has? Let's see if we can get an answer. A little slow. Oh, here we go. There you go. Had 2.5 billion of cash and net debt of 822. So it sounds like they have 1.7. Yeah. 1.7. Okay, so that's what I thought. So in other words, ignore this, and that is the correct number. Basically, it's a 1.7, almost 1.7 billion dollars. So you're buying the company. Let's keep that straight. You're buying the company. So call Carl Icahn, because this is what you want to do. You want to buy the company for $2.5 billion. They've got a cash position of 1.7. So you've really bought it for 800 million. You leverage finance the debt of the company into the cash. Not the debt, the net cash of the company to buy the company. So you need 800 million more dollars. And then in 1 year, they'll make 1.2 million. So you're going to have a $400 million profit in year 1 and whatever value remains in the company, which is basically all of it. There's no reason it shouldn't still be worth the same amount of money. So who's with me? But anyway, the point is, though, then of course I want to play this stock. Of course I want to be in it. So then the next step is now I say, okay, well, that one's pretty obvious. So let's go over here and let's say JXN. And now the first thing I say is, well, they're on a downswing, so I bet you can get good money for the puts. Options only go out till January, but you can sell the 20, it's at 30. I can sell the $29 puts for, a couple of bucks. I can sell the $30 puts for almost $4. That's kind of attractive. Or I could sell the $35 puts that are in the money for $7. That's not as attractive. I'd rather sell the $30 puts that are at the money for $4, which is more than 10%. Because I believe this is close enough to the bottom, I don't mind owning them for that price. So all I'm doing is obligating myself to own Jackson Hewitt at $30, which is where it is now. I'm going to get paid. So let's say we sell 10 puts and pick up $4,000. And now let's see what we can buy. We can buy, well, let's see what our target is. First of all, so our target is going to be, where is that other picture we had of them? Here. So our target is going to be, we don't think it's going to go much below where it is now. And our target is going to be, let's say 40 seems easy enough to obtain, right? So let's say our target's going to be 40. And that means we want to get something like the 30-40 spread. Oh, look how cheap the 30s are. They're only going to be like $4. So it's $4 for the 30s. The 35s are $2 at least. But the 40s are not, let's say $1. So it's going to be net 3 approximately. So it's going to be net $3 on the $10 spread, but I'm picking up $4 over here. So let's say we do 2 times that. So let's say we do 20 of the $3 spreads, right? That's going to be $6,000. and that's going to be $20,000 worth of spreads, but we're going to sell the puts for 4. So that's going to put us into this position for net $2,000 of cash, selling 10 of the puts and buying 20 of the spreads. And it's, again, we're going to be into a $20,000 spread for $2,000. In this case, though, we're at the money. So we are counting on that movement up. So we've got the 30-40 spread, 20 of the 30-40 spreads. Did it make sense to get the 20-30 spreads? The 20s 11 something, and the 30s are 4. That's going to be $7. That's crazy, right? Why would we do that? We think we were pretty confident that we can get to $40. So why don't we play for that? We're going to make so much more money. And if it doesn't work, we can always pay to roll down to a lower strike. But I don't see the point right now. I don't think it's anything urgent, and I don't think there's a reason for it. So we're going to be happy there. Also, because we have 20 long spreads, we could maybe sell 5. Let's say we sell 5 September 30s. If it goes, you know, let's say 30 fails and it looks bad. We sell 5 December 30s, we get, let's say 250. And that's going to be what, $1,250. And if we get that, then we can maybe use that money to roll down the long position that we have. So definitely ways to play it. And it's really a question of, are we catching it at the right time? Is this, you know, why did Jackson go down? You know, the stuff I'd want to check in before I made it an official play as far as timing, because we can only go out options till January. You got to make sure you get your timing right. But I do think that this is a seasonal thing for them and that they should pop back up. So that's Jackson. Didn't get very far, did we? Lloyds Bank, love them down here. NLY is the same management as CIM. I love them too. Simon Property Group, as I mentioned, is the hotel REIT. I'm sorry, the mall REIT. And their competitor, Westfield, just walked away from a mall in San Francisco. They actually walked away, gave it up. It's kind of, business is kind of weird, right? Because like you have an obligation to pay for a space and pay your taxes and so on and so forth. And these guys said this isn't worth it because there weren't enough, you know, there wasn't enough occupancy. You know, San Francisco, you know, they keep raising the property taxes, and the mall is like half empty, and the people who are there. Oh, that's by the way, it's something you don't think about when you see a half empty mall. It's a half empty mall. The people who left are the ones who felt that the rates were too high. Now, the people who stay are the ones who signed a lease 10 years ago for some ridiculous price that they can't get anywhere else, so they stay in the mall, even though it's half empty. But you don't realize that, because when you see a half empty mall, it's in a lot more trouble than you think, because generally the tenants who are there are the ones paying the lowest possible rents. They're the ones with the very long-term contracts from so long ago that the rents are today, they're like, well, where are we going to go? You know, this is the cheapest space we could find. The empty stores are the ones where they're trying to get themselves, you know, something that pays the bills, and they're not getting it. So you see these malls, as they start emptying out, you got to pay attention to which stores left, and think about conceptually, like, you know, how much damage is that really doing to the cash flow of this operation? Because you know, the company can be going belly under long before the mall is completely empty. You know, and in this case, that's what happened. Westfield had to leave. They're like, we can't afford to run this anymore. It's a money pit. But the weird thing about corporations is you can do that, right? You can walk, you know, there's a big giant national company, and you say, well, aren't they obligated? If they're losing money, don't they have to fix it? No, they just declare bankruptcy in the special purpose vehicle or LLC that they set up to handle that particular mall. Because every time they build a new mall, they build a special LLC for that mall that they own. But if that LLC goes bankrupt, they go, oh, not our problem. Then some LLC went bankrupt. We don't know much about it. And that, by the way, is going to be a crisis in commercial real estate, right? Because Westfield, the bank, is very happy to sign an agreement with a company that is backed by Westfield and has Westfield as a partner. But meanwhile, that LLC the bank signed an agreement with goes bankrupt. They got nothing. The bank's got nothing. The bank doesn't want to be running a money-losing mall. And nobody wants to buy a money-losing mall. So it's a complete disaster for the bank. And we're going to see this more and more and more. Now, TD, very surprisingly cheap right now. $110 billion is also 10 times earnings. That seems to be where the banks settle out, right? Look how rock steady these guys are. 41, 43, 42, 49, 50, 49, 50, right? 11, 14, 17, 15, 15, fine by me. I'm only paying $110 billion for the bank and you're going to make $15 billion. I'm okay with that. And again, you know, who cares? But they got $2 trillion. They might be Canadian dollars. Oh, they are Canadian dollars. So we don't really care. So yeah, you got to really take a big slashing discount to them, but it's still, you know, $2 trillion. It still works out to be a good amount of money. You know, TD owns Canada. Literally 50% of all the money in Canada is in TD Bank. You know, like everybody has a TD Bank account. This is a crazy low number. And again, we're at the bottom of the channel. It has gone lower. Okay, it was lower in March when everybody freaked out, but it was only 57. Okay, and just recently it was 57 again after their earnings. People weren't happy with their earnings because again, Canadian dollars, very bad, but doesn't matter. Okay, they're gonna be making a fortune. It's, I mean, you know, long term, great bank, great shape, no problem. Not, you know, don't have those issues that we have with other banks. So that's a great one. So rather than JP Morgan, yeah, sure, TD Bank, probably better. And we'll be looking to put them in our portfolio. And then 2 is another REIT. So those were all the financials I said were probably better than JP Morgan right now. And then as far as companies that are also good ideas, we liked Cake. Cleveland Cliffs is an iron ore producer, but they're an iron ore producer in America. So with all the tariff bullshit and the trade bullshit and the shipping problems and everything else, they're great. Comcast, the problem is they own NBC, and NBC owns streaming, and anything that touches streaming is like death. Like Disney, although Disney's right there too. Crocs should always get. Cisco, I love Cisco here. Dow Chemical, eBay is kind of cheap right now. Expedia Travel's cheap. Ford is a must-have. We got to get them in our portfolio before they get away. Future Fuel, I always like. Foot Locker, we already have. GLW is nice. GNRC, I love. Gold, we have already. HBI, we don't have right now. Hewlett Packard, we love. Intel, we bought, of course. International Paper, we put in. IVZ, I think we put in again. Nordstrom's is actually in pretty good shape compared to most retailers. Kraft Heinz, we just talked about yesterday. They've jacked up all their prices and really stuck it to the consumers. So we're kind of waiting to see if there's any blowback on the prices. But if they're not getting blowback on the prices, they're going to make a fortune. Levi's, again, also, you know, retailers get stuck in an inflation cycle where their prices can creep up on them before they pass the cost along to the consumer, and then they've got to wait and see if the consumer still buys even at the higher prices. It's a tricky situation when there's inflation. But, you know, that doesn't mean you should jump out of them just because they're having a little bit of problems. Logitech, look what just happened. Lovesac Furniture, great. MDT, oh, we were just talking today. United Health. United Health knocked down the entire healthcare sector because they said they're getting a lot of cost pressure because all the people who didn't go to get an operation in COVID, and you got to understand that, right? Do you want to go to a hospital during COVID? If you had surgery that could in any way, shape, or form be put off, you put it off rather than go to the place where people are dying of COVID. So many people put off operations and procedures during COVID, and they're all coming in now. They're all insured, and now United Health has to pay and pay and pay on a much bigger than usual base. It's just a fluctuation though. So for one thing, it's stupid to sell off United Health because it's the same operations they would have paid anyway. And on the other hand, I said, what about the medical device makers? So, and Medtronic is one of them that I really like as a medical device maker. MetLife, I'm a little concerned with the life insurance people because of what was it? I forgot. It was something important. Fire, right? Catastrophe insurance, fire, hurricane, flood, blah 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 blah. The planet is attacking us like we're a virus, right? We're being attacked, and it's trying to get rid of the people, and that's very expensive for insurance companies. So you have to be careful about what kind of insurance they have, and so on and so forth. But on the other hand, the vast pools of money that they have of insurance reserves, right? They are forced to invest them very conservatively, usually in bonds and stuff like that. They are not allowed to gamble with that money. That's their insurance reserves that the people paid for. So now that bonds are paying 5%, that's a huge kick for them in revenues. So that's why I like the insurance companies here. Middleby makes it's an interesting one. They make restaurant ovens. They mostly make ovens. So that's what that company does. And they also make Viking grills and things like that. But they're all the metal kitchen stuff you see that's like the ovens and all that stuff. It's all Middleby stuff. And they supply McDonald's and so on and so forth. So I like them. I think they're just a generally steady business. People got to eat, ovens got to cook, so on and so forth. Metal Steel is a good one. Nike is down on the dumps. NRG is down a bit. OMI is down. Paramount, I always root for. They don't go anywhere, but this is one of those ones that like I buy it and wait. People will realize one day it's worth something. But again, they own a streaming service, so that's very bad. Pfizer is cheap again, which is always stupid. I do not understand why anybody would want to not own Pfizer. The COVID boost is over, but still a spectacular company. You look at them over here. So, oh no. So basically, it's so stupid. So basically, they were making 20 billion, 10, 16, 10, 20, right? So they're making 20 billion. COVID comes along, 30 billion, and they make 30 billion in 1 year, an extra 10 billion. Now they go back to 20 billion per year, and you can buy the whole company for 220 billion. So their PE is like 12. Just because they're not, this is where investors are so stupid. Just because they're not making $30 billion doesn't mean that 20 billion is bad. The logic is insane. And I promise there'll be some horrible disease again that they'll make a fortune off of. Okay, I promise that's going to happen. If people are so crazy with their investing premises. Then we got Prudential and other insurance. Qualcomm is the forgotten tech. I don't know why nobody else, I don't know why everybody rallies except Qualcomm. It doesn't make any sense. Or H, good old Restoration Hardware. Freaking, I can't believe they're cheap again. It's so funny. That's another one where it's like, why would you not buy this stock? RH. Well, not that actually, they went up a bit in June, but they were, they were coming down to 240. It was like definitely a buy. But this is not bad either. This is just a company that just always makes money. Rio Tinto is copper. So if we avoid a recession, that's a good stock. SunPower, always a great stock to buy. SWK is good. Target, we were just discussing the other day. It's tricky because I decided that they're not in a good spot to benefit from if you assume that things are getting worse, then Target's in a bad position. But when things start getting better, so it's a funnel. Think of an hourglass, right? So it's not a good hourglass. It's an hourglass where the top is small because, Walmart is gigantic, right? $500 billion. Amazon, $500 billion worth of sales. Walmart is definitely below Target as far as like the scale, the kind of customers that are going to go in there. Costco probably equal to Target, same basic customer base. Then you've got Walmart below, you've got Amazon at about the same level, right? So Target is fighting with Costco, and Target is fighting with Amazon for customers. Walmart and the dollar store and people like that, they're down below. Kohl's is around where Target is. Then above that, you've got Macy's, Bloomingdale's, things like that, Nordstrom's, who we like. But the problem is Nordstrom's and Macy's are $10 billion in sales each. Maybe 20, but whatever. It's not much. It's not, I mean, nothing like what Target and Walmart and everybody are. So the problem is it doesn't matter if Target steals all of their customers, if those customers decide they want to move down and save money. Doesn't matter. It's not enough because Target is going to lose customers to the lower level suppliers. Now, in a better economy, when the people who shop at Walmart and the people who shop at mostly the Walmart shop, people shop at Walmart, people shop at the dollar store, when they decide to move up to Target, that's a huge boost to Target. And you know, Costco benefits and Amazon benefits too. But as a direct store experience, more people will head to Target and buy back to school and buy their house supplies and so on and so forth. And especially with Bed Bath & Beyond gone, that's a huge benefit to Target too. Same price level audience and not likely to go to Walmart. You know, the vibe of a Bed Bath & Beyond was much more upscale than Walmart. And Target is like good for those customers. But again, Bed Bath & Beyond, 10, 15 billion in sales, nothing that's going to really move the needle. So bottom line though is if you think about it like an hourglass, so Target's like in the middle of that hourglass in a small section, whereas Walmart and every one of the big huge amounts that fill up the bottom of the hourglass, and above Target is only the high-end retailers who aren't going to really, you know, it's not enough sand in that part of the hourglass to make Target happy. So what's good for Target is when the thing reverses, when it gets flipped over and the Walmart customers start looking for better stuff, when they start feeling more flush with cash. We're not there right now in the economy. So therefore, Target is not necessarily a good buy, but that doesn't mean they're not a good value. So again, it goes to, I would like to construct a Target trade, just saying they're going to be flat for a couple of years. And if they go up, so much the better. But as long as they stay here, or as long as they stay flat or up from here, we can construct a very profitable trade. Ooh, Fed time. So we got TNDM, Trox, TRVG. We decided, Trox is great, but no options. TRVG, great, but no options. Vail is a great company. Walgreens is another one I bang the table on constantly. They haven't really popped yet. Whirlpool, if they're on sale, we buy them. WSM also, I like them. They're in the top of that hourglass, way above Target. Weyerhaeuser for the paper. US Steel, of course. Xerox is kind of cheap. And of course, our stock of the year is still Yeti. And we're still waiting for it to actually move. So what did the Fed do? Let's look at the chart. Oh, they raised rates a quarter point. Oh, that's what I said they were going to do. Let's see. Ooh, I'm not supposed to say what happened until I read it, right? The committee decided, oh no, they maintained it. Well, what's the big deal then? Oh my God, they paused and the market collapsed? In the way the committee seeks to achieve over the next, in support of these goals, committee decided to maintain the rate for the funds at 5 to 5.25, holding the range steady, blah, de blah, in determining the extent of additional firming may be appropriate to return inflation. The committee will take into account cumulative tightening policy, the lags of monetary policy, blah, 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 the mortgage-backed securities. So the committee is strongly committed to returning inflation to 2%. And if you were strongly committed to it, you would have raised rates a quarter point. That's bullshit. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of the upcoming information of the economic outlook. The committee would be prepared to adjust the blah, blah, blah. This is garbage. How on earth does the market freak out about that? What did they think they were going to do? Oh my God. Oh, it's so funny. Aren't you glad we have the hedges now? All right, so let's see. FOMC rate parsing. Passing, not passing, parsing. Latest. This is latest. April 10th. Why does it say that? Okay, nobody's got it yet. FOMC. Oh, the Japanese are all over this. Chinese, that's Chinese. That's Japanese for sure. Okay. That's Chinese. That's Japanese. That is just amusing myself, frankly. I'm going to say Japanese. Okay, so Fed pause rate increase, blah, 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 blah. Federal Reserve paused. Federal Reserve notes. Everybody's like freaking out about how fast it moved already. No more FMC dots below 5%. Ooh, there you go. It's the dot plot that's killing us. So in 2023, everybody is over 5%. Nobody. So in other words, what it is, it's not about what the Fed is doing. It's about the fact that nobody, not one person on the Fed, that's what these dots represent, not one Fed governor believes that the rates are going to be lower than 5% this year. And most of them believe 5.5. So in other words, the Fed governors as a group, there's only one guy who hits my target of 6%. The governors as a group believe that there is 2 rate hikes ahead, or at least one, probably 2. So that's where the majority of the Fed is. There are 2 more rate hikes ahead. There is no reduction coming, which of course was completely asinine and was never going to happen. But that's shocking the market right now. Next year, even, we're still at 4.5. There's no great reduction expected next year. And I think, well, again, I think the problem is, and somebody just said it today, that the stickiness of wages, and we've talked about this before, it's like you can't expect inflation to stop if you aren't paying people enough money. You still have to raise the salaries before you can even begin to think about pausing inflation. And wages have not kept up with inflation. Therefore, wages have to catch up, and then you can tell me where inflation is. Wow, I wish I had more conviction when you should have shorted. That's funny. Oh, wow. That's brutal. Look at that. It's so silly. It's like, what on earth did they think was going to happen? Oh, there's that dollar thing. Remember I told you I thought the dollar was being punched down this morning? It's the first thing I said. I think the dollar's being artificially pushed down to hold the market up. And when the Fed comes out, that's exactly what happens. Because, all right, now what's the logic there? Our Fed is more hawkish than other Feds, than other central banks. So that's what causes it. If our Fed is more hawkish than other central banks, then our dollar will be stronger than their weaker currencies. Very simple. None of this stuff is complicated. Oh, questions. I wonder if anyone has a question. Nope. Just people commenting on the Fed. Jackson with an 8% dividend. Why not buy the stock and sell the puts and calls? Yeah, it's a question of whether we figure out what's a better trade. So it's valid. We don't really have a dividend portfolio though, so it's not been a high priority to look for dividend paying stocks. We ran the dividend portfolio for a few years. It did very well, but it's so unbelievably tedious. It's just, so I haven't really gotten back into it. And 8% is good if they're going to maintain it. But is it the best use of our money? So let's take a look at that for a minute. So here's Jackson. if they have longer options, it might work. They're at 29.70. So let's say we sell the $25 calls for $6.90. All right. So it's 29.7 minus 6.9, and that's called away at 25. Okay. So that's fine. And then we sell the well, let's say we sell the $30 puts, and we said we get $4 for them, and they just did sell for $4. So minus $4. So that's $18.80. So here's what we've done. We buy the stock for $29.60, well, $29.70. We buy the stock for $29, whatever the hell it is. We sell the $25 calls. They're quite a bit lower, but they still have, if you sell them for $7, they still have I'm sorry, that's net. No, that's 22.50. Sorry, 25. That's net 32. Okay, so it's still like much higher than the stock is. You're not going to get called away for no reason. Okay, so you're going to hold on to the stock. You're going to collect your dividends, and your net is now, when you sell these guys for $4, the $30 puts for $4, that obligates you to buy more for 30. But your first batch is locked in at $18.80. So if you buy more for 30, you're paying $38.80, which is what, 19, no, $38.80. It's like, it is like $19, right? It doesn't make any sense. $48.80, that's why. So it's $24.40. So your average, in other words, if you're forced to buy more at 30, your average is going to be $24.40, which is $5 below the current price. So you're 15% plus below the current price would be your worst case scenario. Meanwhile, if I get called away at 25, because I sold the $25 calls, I'm going to make $6.20. That's 30% in 200 days, just in 7 months. Both could happen, but still you make your money. You're going to make your money on this side, and then you're going to be in at a cheap position, and you roll it around and do it again. Plus, while you're waiting, you're collecting the dividends. That's pretty freaking attractive. So I'm not going to say no to that. That's a pretty attractive way to play dividends, and we should teach people how to do that. So maybe we are going to use that in the portfolio. Now, you say versus what? Okay, so what's our overall premise? Our overall premise is 25 is a good price for these guys. So on the same basis, though, we can sell the $30 puts for the same, I think we said $4, right? Yeah, $4. So we sell the $30 puts for $4. And then what kind of spread can we have? Well, if we sell the 30 calls for $4 and we buy the 2250s for $8.50, no, let's go these for $10.50. So we buy these guys for $10.50, the 20s. We sell the 30s for $4, so that's net $6.50 on the spread. And we sell the $30 puts for $4. So now it's net $2.50. So our entry is really $22.50. So at 30, we're going to make $7.50. We're going to make $7.50 on our net $2.50 entry. So $7.50 is more money than we would make tying up the spread. So the only difference is if we get assigned, and if we get assigned, we're in about the same shape. So it's going to be 20. It'll be a little bit higher. It's going to be $22.50. So it's 22.5 plus 30 divided by 2. So it's 26.25. So we are paying a little bit more for the stock if we get assigned, but we're going to make more money and we're tying up less money going the other way. But we're foregoing, then we have to actually, so then we have to calculate the dividend that we're foregoing to see if that makes any sense also. So it's a tight one, but again, because it's so close, because it's definitely going to be very close, I would lean towards buying the stock just as a good example. But on the other hand, in the income portfolio, I buy 1,000 shares of this for 25,000 bucks. That's a big chunk of my income portfolio. That's the problem. I'm tying up $25,000 on this one play. And but it's going to make 30%. It's very likely to make 30%. And that's obviously a very good amount. So if I can make 30% in 7 months with a play where I own the stock, that's pretty tempting. So I think that might happen. All right, we'll do more of the math later in chat. But anyway, what were we talking about? The Fed. Remember the Fed? I remember the Fed. So that's what we want to look at now. Is let's take a look at Fed. Here you go. That's not the Fed we were looking at. This is. Is that the same thing? All right. Oh, where's my? Let's take a look at the Wall Street Journal and see what those guys have to say about this mess. U.S. states ranked by population. WSJ. Fed holds the rate steady, but how do you read that? I guess they're going by the dot plot. Federal Reserve officials.
When Fed Chair Jerome Powell speaks.
Federal Reserve officials agreed to hold interest rates steady after 10 consecutive increases, but signaled they are leaning towards raising them next month if the economy and inflation don't cool. Most of them penciled in 2 more rate increases. That's what I said from the dot plot thing. That's where they're getting that from. And lifted their expectations for growth and inflation. In the statement, 5.5, 16-year high, holding the rate steady. After holding the Fed funds rate near zero following that's also is unanimous. So that's probably, that also indicates that nobody's really pushing it to stop or to reduce rates. Others turn less confident about the need to raise rates. We've come a long way. Powell said some into the potential. All right, now they're just reviewing stuff that people said before. Bank failures, projections. Nothing there. Okay, now let's go to the dot plot. HTML. Summary of projections. Okay. Seems like a lot of stuff. Wow. All right, that's risk to GDP growth. Core inflation, PCE inflation. Okay, let's do this. Okay, PCE inflation. Copy. Find my buddy. Can you please summarize and analyze the following? Your session expired. Oh, come on. Boo. Please. Okay. Okay. provide information, summary of projections made by participants, open, blah, blah, blah. Projections include forecasts for real GDP, unemployment, inflation, Fed funds, as well as the long run projections of participants, projections based on the information available at the time. The longer run projections represent the views, blah, blah, blah. Okay, here are the key points. Change in GDP. The median projections indicate an expected GDP growth rate of 1% in 2023, 1.1 in 2024, 1.8 in 2025. This is some very sad growth. The central tendency ranges from 07, blah, 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 blah. Unemployment rate. The median projection suggests an unemployment rate of 4.1% in 2023, which should rise a bit and stabilize at 4% in the long run. Okay, PCE inflation. The median projection for PCE suggests a rate of 3.2 in 2023. So this is important because these are the numbers the Fed cares about for making their policy decisions. So when you see numbers coming in higher than that, they're going to be more inclined to raise rates. Which is expected to decline to 2.5%. So what they want to see is 3.2% heading to 2.5%. If they're not seeing it, they got to raise rates. So what they're saying is they don't need to see 2% now. They just need to see that they're getting to it by 2025. That's what the Fed is hoping for. Core inflation. The median projection for core inflation for food and energy is suggested a current rate of 4%, then down to 2.6 and 2.2. So they're really not expecting inflation to be 2%, their target, until 2025. They're giving it a very long, slow ramp to improve itself. And the Fed funds rate, they see the Fed funds rate at 5.6% this year. This is what everybody's freaking out about. 4.6 next year, still pretty high from what we've been used to, and 3.4. I don't get this. I don't see how now. I don't know what happened in the world that now 3.5% and eventually 2.5% is what they consider a normal rate. That's really low. Historically, you were not able to borrow a home mortgage at 3%. That'll be great if it happens. It's going to take a long time to get there, according to this. But basically, if you are thinking about buying a home, they're telling you to wait until 2025. They're going to get those rates back down to 3-4% for homes. Or, see, but this is the dangerous part, because you know what it also tells people? It tells people to wait or to get an adjustable mortgage, which frankly, Greenspan encouraged people to get adjustable rate mortgages because he said that inflation would bring down the Fed funds rate, but that never happened. And that screwed people over tremendously because adjustable rate mortgages are the worst. They are the worst if rates go up or if they're flat. They're terrible. They're not good prices. You're always better off with a 30-year fix, but the problem with a 30-year fixed is if you're locking in 30-year fixed now, it's too high. And yes, you can refinance later, but it's too high. So so either they're lying to protect the housing market, or just I would wait. I would just rent until this blows over, because I don't know what's going on with the housing market. I wouldn't plus I wouldn't buy a house right now for many reasons. All right. So anyway, so that's that. And now we can go down. See how nicely see how good he is at that? Now, so now we're on figure 2, and now we can go down here, and down here, and down here. Oh, this is so much stuff. Uncertainty risks, assessment, uncertainty, unemployment. No, I don't want to go back. Yeah, let's just stop here. Okay. Okay. And go back. And by the way, I have the thing about ChatGPT, which is Warren, which we call Warren, is that if he's incredibly good when you feed him the data. If you ask, he can't make up the data. He doesn't know what happened. He doesn't even know that it's not 2021. But if you give him data and say, read this and tell me what it means, he's amazing at it. So I do trust him. He's not going, because he's not going to go and make things up like Bing does. He is going to take what he sees in front of him and he is going to analyze it and tell you what happened. So I mean, like explaining it. Figure 2 shows the assessment and appropriate monetary policy by the Fed. It presents a midpoint target range for the Fed funds rate. The values range from 2.5 to 6.25 with gaps. The number of participants vary each year, with the highest participants midpoint projection 5.625 and 2023. That is 2 hikes ahead of where we are now. 3A depicts the distribution of participants' projections and the change. 3B displays the distribution of participants' projections for unemployment. They think it's going to be 3. This is more of a reiteration. This is more of like the range of responses that led to the first part, so it's really not important, honestly. I was just curious if anything was off. And so, you know, now we'll look at the raw data. You see what it is. It's honestly, it's not that hard to interpret anyway, but it's just nice to get a quick summary of it. So projections for the appropriate monetary policy, and this is where it came from. And what's important though here is to look at what changed. And Warren doesn't care about that, but I do. In other words, so in March, they thought this. So change in GDP, and they see it at 1% now. They thought it's gotten better. 2024 got worse. That's weird, right? So this year is better than they thought. Next year is about the same, a little worse, and the year after that is a little worse. So in the last 3 months, their short-term assessment for GDP has gone up, but long-term, they still see it as being pretty lackluster going forward. Unemployment rate, that has gone down in their anticipation. They thought there was going to be more unemployment, but over time, they aren't changing their minds. Inflation, there's really no change in the inflation at all. PCE inflation, there is no change. Well, actually, I'm sorry, they've conceded a little bit higher PCE this year. See, and that's not going according to plan. Their plan, they just said it in the statement. They say 3.6 going down to 2.6 over the year. We're at 3.9 now. It's already 10% ahead of where they want it to be. So we will see. And then the Fed funds rate, they thought it was going to be 5.1 in March. That's important. They in March thought 5.1. Now they think 5.6. They've raised their expectation for the Fed funds rate by 0.5 point. And next year by a 1/4 point, basically. And then the year after that, a 1/4 point. So everything is higher, even though they're pausing. They're overall saying we are going higher. And that's why the markets are not happy. And the rest is just blah, blah, blah. So that's what's important. It's how everybody stands and what things are looking at. And now Powell's going to talk. That could be crazy stuff too. Let's see how he does. Oh, good time to check on the short-term portfolio. And then we get to play the great game of find the remote. Okay, so it was minus 7.3 and now it's minus 6.2. Not much of a change. Found the remote in one shot. First place I looked. Will the TV go on? Will I find the news channel? These are all exciting things. Yep, Bloomberg right there. Good job. Last time I was on it, last time we had a Fed thing, that's the last time I used this TV. I never use it. There he is.
Good afternoon.
Oh, right on the button.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people.
Ooh.
We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2%.
Further rate
Yeah,
increases.
I'll have more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators.
Oh, there goes 400 points on the Dow.
Continue to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates.
Housing sucks.
Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer run normal growth rate.
Crappy growth in GDP.
The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month.
Labor is still tight, obviously got to watch that.
It moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the consumer price index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go.
What on earth is that?
The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile and food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets.
What is this? Jesus Christ, these aren't even government accounts.
To promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet higher costs like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points.
10.1.
We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy.
That's still huge.
Investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting,
so he's reiterating they do intend to raise rates. But you see, the NASDAQ and the S&P are recovering already. The Dow's being a baby about it for some reason, the Russell too. But there's nothing wrong with what they're saying. I don't know what people would have wanted otherwise.
2% over time. The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments.
Huh.
In our SEP,
Still can't get over 10.
wrote down their individual assessment of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025.
So his speech is basically just reading what we just went over. Getting boring.
I hasten to add, as always, that these projections are not a committee decision or plan. The economy does not. Policy will adjust as appropriate to foster our maximum employment and price stability goals.
Yeah, he's saying they're still data dependent, blah, blah, blah. The main thing is that during the Q&A, usually he might say something's off book there, but it's fine. I mean, it's really what the market wanted. They got their pause, and the language says they're going to raise, but you know, the market whined and cried and got the pause they wanted. So there's no reason to think they won't continue to get what they want. So that's where we're going to be. All right, guys. So where was I? Oh, I think we went over all these things. So over the next couple of days, we're going to be, since nothing catastrophic has happened, we're going to take advantage of whatever we can. And we're going to add a couple of these stocks to the long-term portfolio. And that's how we do it. That's the thing. It's been so long. Like 4 years ago when we started building the long-term portfolio, that's exactly what we did. We have our watch list. We look over the watch list and see what things look cheap and what should be bought. And then we look every day we go shopping. We look at our list and we say, oh, what's still available? We can get that, we can get that, we can get that. So we buy 3 or 4 stocks this week. And if they don't collapse, then we buy 3 or 4 stocks next week. And if they don't collapse, we buy 3 or 4 stocks the next week and we build up the portfolio. That's what you do at the beginning. You just keep picking them off one by one. But you don't want to overdo it. You don't want to get into stocks that are too expensive. You don't want to blow all your buying power. You want to make sure you're flexible. But think about it. If you do it like this, and let's say we do 3 a week for 2 months, right? So we're going to end up with 24 stocks, and that's over 2 months. So that means the only reason we keep buying the 3 a week is because the first month didn't collapse, right? So that means we've got, in the first month, we have 12 stocks. Those 12 stocks have had a month of good performance, which is effectively, you know, when we look at our portfolio and we say, oh, not that one. But, you know, we go to the income portfolio and we go, oh, it's up 17%. That's 1 month. So that's a buffer already for the next month that we add. So then we add more stocks next month in the LTP too. But like I said, in the LTP, we did a little bit more aggressive as far as the positions, and we're paying for it right now. But in the LTP too, we added 8 stocks in the first month, or 9 really, 9 stocks in the month, and it only started on 5/16. And this is what we're up to now. Next, well, this is month 1, right? So next month, starting next week, we start adding another 3 per month, 3 per week, basically, in the thing. And we're only adding them because everything's fine over here. As long as these are positive, we keep adding. And so if in month 1 we have 8 stocks that make 1.5%, if things continue to go well in month 2, we'll have 16 stocks that make 3.2% that month, and then we'll be up 5% total. And we're not going to keep adding at that pace, but as things go on, we make 3.26%, and then we make 6%, then we make 12%, and then we make, by the end of the year, we should be up a good 15, 20%. And then in a $500,000 portfolio is great. Then we take that money and we roll it into next year, and next year we make 25% and we make 30%. And that's how you expand very quickly. You go from 500 to 650, you go from 650 to, I don't even know, it's hard math. Let's see, wait, 500 plus 15% would be 650, right? No, that would be 30%, that's why. So let's say you go from 500 to 600 in the first year. And then the second year we make, let's say 20%, and that would bring you to 750. And then by the third year, you're at $1 million. And yes, we did much better than that before because we happen to have some really good picks. We may happen to have some good picks now, but just conservatively letting it grow at a nice slow pace, we're 3 years to doubling up the portfolio. That's conservatively. If things go well, maybe 2 years, and then maybe by 4 years we'll be at $4 million again, like we were last time. But that's all it is. It's just being a little bit ahead of schedule. We had 4 years in the last run, and we went from $500,000 to just under $4 million. But what is that? That's going from 1 million, 500,000 to 1 million, 1 to 2, and 2 to 4. That's all it is. And the thing is, though, that we get more aggressive as things go on. So if we are ahead of schedule, as we were in the last portfolio, and the reason was, by the way, we came in 2019, started our portfolios. There was a huge crash at the beginning of 2020 from COVID. We had not deployed much capital yet, and we jumped. Then we went all in when everything was so cheap at COVID, and that gave us a huge boost. So we were like at $1 million in our first year because we jumped in the COVID crash and then rode everything back up. So we doubled up in the first year. Then we cashed that out, had a huge amount of cash. There was another dip in the market. We bought up stuff again, and then we were well on our way to getting 2 million. That's how we ended up with 4 million. Just timing worked out in the portfolio. But on the other hand, if you look at $700 a month portfolio, we never had a month like that. I mean, that's just crazy. So we'll see how that keeps going. The income portfolio is off to a great start too. That's only a month, right? 515, yeah. So when we're off to a really good start, then we tend to take a lot more of the not necessarily riskier plays, but they're more of a gamble. We have the flexibility to take things that are more aggressive, and that's the key. But you can't plan on that, and you certainly can't make that your game plan for investing, that you're going to do all these crazy risky things. Our game plan for investing is we try to make 20 to 30% a year, and if we're ahead of that, we'll take that extra money and we'll gamble with it, and if that works out, then suddenly we're way ahead. But we don't plan on the gambling, we plan on conservatively investing, and sometimes we get lucky. Sometimes we pick up SoFi. And we're what is this, 10,000, 12,000, we're $12,000 up in a month. That was the first trade we put in here too. So sometimes we pick one, we get one trade that makes a ton of money. But that's fine. That's the goal of investing. They're not all going to be jumps winners. Look at this one's another one. It's Intel. So great gains on Intel, great gains on SoFi. SunPower is doing very well. I mean, it's yeah, of course. In fact, every single trade, there is not one on this portfolio as a trade. If you add, if you positive negatives, right? There's not. Oh, this one. I'm sorry. There is one. There's Energy Transfer is currently below. Oh, speaking of dividend stocks, right? So here's the dividend stock. So Energy Transfer is a bit behind at the moment, though they haven't paid their dividend yet. But other than Energy Transfer, and it's a very small amount, and it's from last week. So everything is going well. That's the point, though. Everything should be going well. Everything should be making its normal amount of money. Once in a while, somebody's going to wildly outperform. And if somebody wildly outperforms, that's to our benefit. And what do? We lock in our gains and we keep going. So I'm looking forward to building this thing up. We have a lot of stocks to go through, but I think we're in very, very good shape. Couldn't ask for a better start, really. And we will see what happens in the future. Okay. So this week, stay tuned. We're going to pick some stocks, and next week we're going to pick some more. Don't forget Monday's a holiday too. It's Juneteenth on Monday. All right, thanks for coming, everybody. Enjoy whatever the hell Powell is talking about, and I'll see you again next week. All right, take care.